In this video, I'm going to show you why it's so important and how to pick the right strategy for each market. Because you could have a really great trading strategy, but if you apply it to the wrong market or even the wrong time frame, then all you're going to do is end up losing money. By the end of this video, you're going to have a really good idea of how to tell how each market and each time frame behaves, so then you know which strategy to apply to each market in order to make most money. Many strategies fall in two kind of broad categories. Some strategies are kind of trend following, so they may buy breakouts of new highs or resistance levels, or when the market becomes overbought, then they buy and they go long, or they do the opposite. So when the market rallies towards that resistance level or the new highs, they do the opposite and they sell short. So they're more of a reversal type strategy. So we're looking at either trend following in the direction of the trend or reversals. The problem is we're often told, whether it be in a YouTube video, maybe on a website or in a book, that here's a trading strategy and maybe it's designed for Forex, which is very broad. Now, here's the strategy, go and trade it on the Forex markets. Some might even be more specific and say, go and trade it on just the major Forex markets and whatever time frame suits the trader, suits ourselves. But if you were to do that, and maybe you've already found this out the hard way, then sometimes all you're going to do is lose money, because if that strategy isn't designed specifically for that type of market, then it's just not going to work. And that's what this video is about. It's going to show you with hard evidence why markets do move differently. Firstly, I'm going to show you, and I'm going to put the diagrams on the screen in a minute, the results showing the equity curve of the exact same strategy applied just to two different Forex markets. This first strategy is applied to pound versus the Japanese yen on a 60-minute time frame. And now let's apply the exact same strategy to US dollar versus the Canadian dollar on a 15-minute time frame. What vastly different results we get from trading the exact same strategy just on two different Forex pairs. Both Forex, both even major Forex pairs, but I think that proves immediately that you cannot use the same trading approach or same trading strategy on two different markets without understanding first how they work. I'm going to show you more results, and I'm going to show you how I came to that conclusion. And I'm using about 13 years worth of data, so the past 13 years, right back to 2008. So we can see that this behaviour is consistent throughout that amount of years. So next I'm going to show you how to perform this test on any market and on any time frame. I'm splitting the test into two main categories of strategy or market. So I'm saying the first type is a trending market, meaning that it responds well to buying breakouts of new highs or selling short breakouts of new lows. And then the other category, which is mean reverting or counter trending, meaning the exact opposite. So we're shorting new breakouts of new highs and buying breakouts of new lows. It'll be much easier to explain when we go over to the computer now, and I'll show you it on the charts and how to perform this test on each and every market and time frame. I've programmed in Multicharts a piece of code which does one thing or another, and I can switch it to trade each strategy really easily, as I'm going to demonstrate. Firstly, it uses a very simple breakout technique or strategy, and it's a classic one. We're just going to use a Donchian channel, and we're going to look at a 20-bar breakout. So it could be a 20-day, it could be 20 30-minute bars. So it's a classic 20-bar breakout. So if the price breaks above the highest high over the last 20 bars or 20 days, then it's going to buy. And it gets out when it does the opposite. So it gets out of that long position and then enters a short position when the price breaks below the lowest low over the last 20 bars or 20 days if it's on a daily chart. But then I can just switch the input and switch the strategy around to do the exact opposite. So if we see a 20-day high or a 20-bar high broken, instead of buying and getting on that trend, it will actually short sell. So it will go against the trend. So this is our counter trend strategy. And the opposite when the 20 bar lows are broken, rather than short selling, it will then cover the short position that it's in and it will buy. So we're buying the 20-day lows. All I need to do is apply that strategy on any market and any time frame and run it to see how that market or that time frame actually behaves and responds to either one strategy or the other. And this will then give us a really good idea of how that market and time frame responds to other types of strategy, other types of breakout strategy or other types of mean reversion or reversal type strategies. So let's have a look at these examples that I've prepared for you. So I'm going to show you 4 separate charts, which are 4 separate markets and 4 separate time frames. So 4 charts in total. Let's look at this first one because I've actually got the Donchian channels on it. And if I maximize it, we can see this is pound versus Japanese yen on the 60-minute or the hourly time frame. And at the moment, I've got this set up in the trending direction. So if we look, we can see a buy here. See, price has broken above this upper Donchian channel, which is showing our 20 bar high. So we buy, and then we don't exit until we see a break below the lower channel or the 20-day low. And you can see we've exited the buy and we're into a short trade. Just going back, you see we bought the breakout of the upper channel and we exited and then shorted the breakout of the lower channel and so on. So we'll look at the equity curve of that, which you've already seen, and we can see that over that 13-year period, I think you'll agree that it's moving upwards in quite a nice uniform direction, meaning that pound Japanese yen on the hourly time frame is just quite trendy. So we want to be looking at applying breakout techniques and that type of strategy for this market and time frame. Now here's where I can adjust things and do the opposite. If I go to my strategy and I've created this input called trending, and if I've got it set to 1, then it does exactly what you've seen. If I change that to -1, then what it will do is the opposite, and we'll see the examples on the chart. So now we can see, if we start back here, we've had a breakout above the upper channel. So on the next open, we short sell. Breakout below the lower channel, and we buy. Breakout above, we short. Breakout below, we buy. So it's doing the exact opposite of what we've already seen. So let's have a look at the results for that now. And what a different story that is. So clearly trying to apply a reversal strategy or a counter trend strategy on pound yen on the 60-minute time frame is never going to work, is it? But let's look at our other example. Now, you've already seen this one as well on the equity curve that I showed you earlier. And this is US dollar, Canadian dollar on the 15-minute time frame. Looking at the equity curve, we can see we've got a really nice, smooth, uniform equity curve over that 13-year period. And this is actually on the counter trend trading strategy. So we can see, I haven't actually got the Donchian channels on here, but we can see we've got a 20-day low here, which we're buying, and we've got a 20-day high here, which we're short selling. And that works well with this market. But what happens if we do the opposite? Let's turn it around. So you see I'm on -1, so that's the reversal or the counter trend. Let's put it on the trending version. And now we can see we've got a breakdown of a 20-day low, so we short sell, and we've got a break up here of a 20-day high, so we buy. And look at the results there, completely horrible. So comparing this chart to the market that we've just seen, the pound versus the Japanese yen, we need to be looking at 2 opposite approaches for each of these markets, don't we? Let's look at another 2 examples. In this chart, we've got euro versus the pound on a daily chart or a 1440-minute chart. And we can see that we've got my input for the trending on -1. So currently it's on the counter trend. So look, we've got a down move, we've got breakouts below the low, and we're buying. And then we've got breakouts above the recent 20-day high, and we're short selling. And we can see that that's actually probably been quite favourable over those 13 years. Let's reverse it. So is euro pound on the daily chart a trending kind of strategy? Do we want to be buying breakouts of highs and shorting breakouts of lows? No, we don't, because these are the results. And look how terrible that is. So now we know euro pound on the daily chart is a mean reverting, or it responds better to reversal type strategies. And the last market, just as an example again, we've got US dollar, Japanese yen on the hourly time frame. And I already know that Japanese yen pairs do tend to trend quite well. So that's what we've got at the moment. We're buying breakouts of new highs and shorting breakouts of new lows. And on the hourly time frame, look how well US dollar, Japanese yen responds to buying breakouts in the direction of the trend. Let's just reverse it. And I'm sure you'll know what to expect when we try and use a reversal type strategy. Yeah, completely horrible results. I mean, there has been periods of probably 6 months or so where it has worked, but there's no way you're going to want to trade this over time. But if you didn't know, if you hadn't done this study, then you might be applying a counter trend strategy to this market and time frame, and that's why it wouldn't be working. What I've demonstrated is how drastically different each market and each time frame can move. But how does this help you with your trading? Well, what it does is it gives you a very good idea of what type of strategy to apply to each market and time frame, because we can clearly see that applying breakouts in the direction of the trend to some markets is just going to be a money-losing strategy, and reversals on some markets, or mean reversion on some trending markets like the yen pairs, is just going to be a money-losing strategy. Unfortunately, there are people who will give away strategies, or so-called working strategies, and say, here you go, take it away and go and trade it on whatever Forex pair you want and whatever time frame you want. Almost like there's a one strategy fits all markets approach, but you can clearly see that that's just never going to be the case, because they all move very, very differently, and the key is applying the right type of strategy to the right market. This probably isn't the most exciting of my videos, and it's not going to be a giving you away a 85% win rate strategy or anything like that, but this sort of stuff is key to developing consistent profitable strategies. And maybe it's a bit boring, but this is the kind of studies that I do on the markets all the time. And I mean, I've done so many now that I actually understand. I understand how a breakout strategy is much likely to work more on the yen pairs than on things like euro pound. But this is the bare basics. This is the bones or the foundations of how to create strategies from the ground up, and not only creating your own strategies. If you pick one up on YouTube, for example, then if it's a breakout strategy, you're going to have to apply it to a market that responds well to breakouts. You're not going to want to apply it to a market that is very mean reverting or better for reversals. So I hope you might have learned something from this video, and if you've enjoyed it, then please hit the thumbs up button now. And if you've got any comments or questions, leave them below in the comments and I'll do my best to reply to those. But until the next one, this is Jared Goodwin, and thank you.